Hi, this is Paramdeep from Pristine, and today I'll speak about the steps to create an integrated financial model. So, just to summarize the various steps, these are the steps to create an integrated financial model. I'll take you through the model step by step, and also I'll show you in the model how these steps are to be followed. So, the first step in creating any integrated financial model is essentially to have a good layout for the model. So, if I were to just summarize it, so for example, in this particular layout, you can see that the layout is very clean. One, two, it has all the units specified. So, for example, all the units are in dollar million or in number of days and so on. The other thing is that there is a clear demarcation for the balance sheet assumptions, the revenue assumptions, the cost assumptions, and the asset assumptions. You can clearly see that I am using column A as my first navigation column, right? In the second column B, I am using it as a second level of sort of the table of contents, and I am fixing column E for the year FY05. If I go to the revenue buildup, I still use column E for the FY05. If I go to the cost buildup, I still use column E for FY05, and so on. So this gives me a simple sort of help in the form that whenever I am calculating anything, so for example, let's say if I am calculating the values for FY06, I will always know that I have to link column G to column G. Obviously, the opening balances in column G are going to come from column F, right? So, so there are some specific sort of tricks that you can follow to create an efficient layout for your model. And finally, the goodness or the value of your model will come through the efficient layout. So when we start creating the model, the first thing that we'll sort of lay our stress on is creating an efficient layout. I hope that's clear. Yeah. So just to summarize, the first step is sort of creating an efficient layout. Once you're through with the layout, sort of the first technical step in creating any model is essentially inputting the historical numbers for the balance sheet and the profit and loss account. Is that okay? Typically, to demarcate between the constants, that's basically the assumptions, and the calculations, I use a blue colored font for the inputs or the assumptions, and I use a black colored font for the calculations. So just to summarize, the second step would be inputting the historical numbers. For your balance sheet and your profit and loss account. Now, obviously, once you have the historical numbers for your balance sheet and your P&L, the next step is to figure out what are the growth drivers. Right, so the next step that we would be following is basically figuring out the growth drivers. Now, as far as the P&L is concerned, the main growth driver is in the revenue is the growth. So year-on-year growth, or the CAGR, the CAGR, essentially the cumulative annual growth rate, or the year-on-year growth rate. So this would give you a trend about the company. So how is the company growing, or is it degrowing? Now, based on the revenue, you can almost assume that the rest of the costs would remain as a percentage of revenue. So I take the percentage revenue for various costs. Is that okay? So these costs could be mainly the raw material cost, or it could be the let's say the manufacturing cost, the cost of goods sold, and so on. Even the manpower cost I can assume as a percentage of revenue. Now, so if I were to just go to my model and show you out here in the assumptions, we sort of build a cost for the revenue. So I'm trying to calculate the year-on-year growth. Is that okay? For the prices and the volumes. So price multiplied by the volume essentially gives me the revenue. Is that okay? Similarly, I see the kind of growth that is there in the headcount. I see the growth that is there in my salaries, right? And so on. So some of these I just calculate as a percentage of revenue. Now for the balance sheet drivers, essentially I would calculate the major heads. So for example, I would calculate the number of days of inventory. I could calculate the number of days of payable, I could calculate the number of days of account receivable, and so on. So out here I calculate from my balance sheet. As you can see, these numbers are linked to the balance sheet and the P&L. So these numbers are not assumptions, these numbers are calculated drivers. Is it okay? So I calculate the number of days of inventory, the accounts receivable, and the various other balance sheet numbers. Is that okay? Now once we have these numbers, the next thing is sort of making your own assumptions. So you have seen the trend. Now you go about making your own assumptions. So these assumptions are forward-looking assumptions. So you make some assumptions about the future. Okay. So looking at the trend. So for example, if I go to my model, looking at the trend, I figure out that they were holding around 110, 111 days of inventory in the past. So I am assuming that they are going to hold 115 days of inventory for the first 2 years, and then they hold 110 days of inventory. Similarly, if I'm assuming that their if I take a look at their volume growths, the growth has tapered down. Based on this, I sort of make some assumptions. So the growth is around 18%, 15%. So I make some assumptions about the price and the volume. So for example, the growth has tapered down in the prices. So I make an assumption that they would not be able to increase the prices in future, and sort of I make some assumptions about the volume. Now these assumptions you will have to sit with the management of the company and then figure out their possible outlook about the future. Right? Now based on these assumptions that you have made, the next step would essentially be projecting your own. So you would be projecting your own balance sheet. So you would be projecting the future numbers for your profit and loss account and the balance sheet. Is that okay? So the next step that I follow in my model is essentially figuring out. So from the assumptions, I drive the revenue, the costs, the various costs that I have to calculate. Is that okay? So I drive the various costs from the assumptions. As you can see, these are all linked to the assumption sheet, right? And based on these, I calculate my balance sheet and my profit and loss account in future. Is that okay? So most of these are linked to revenue build-up, cost build-up, or the assumptions. Is that okay? So you can see in the formula bar that they are linked to assumptions, they are linked to the cost, and they are linked to the various revenue build-up that we have. Now please note that while creating this model, there are some things that cut across the balance sheet and the P&L. So the things that cut across the balance sheet and the P&L, I'll keep them separate. So for example, in my balance sheet, I have an asset. Is that okay? And the corresponding entry in my P&L is the depreciation. So I will create a separate schedule for the asset and the depreciation. Is that okay? So if I go here, I calculate a separate asset schedule. So I know when the next investment is going to be made, and I calculate its corresponding depreciation schedule. Similarly, if you know that in the balance sheet there is this item called the debt, and along with the debt in the P&L you have the interest. So I sort of create this schedule separately. So if I go to the debt schedule, there's a debt schedule and then there's an interest. Is that okay? So apart from that, if you know in your balance sheet you have your equity or your reserves, and correspondingly your PAT number flows from your P&L into your balance sheet. So I create these these items separately. I hope it's clear till this part how the model is to be. Now once this part is created, what I essentially do is that I create the cash flow statement from these. Is that okay? So I create the cash flow statement. As you can see, the cash flow statement is primarily linked to the profit and loss account, your balance sheet, your various asset schedules that you have created, and the equity schedule that you would create. So based on this, the next step that I follow, so that would be called the step 7, is essentially creating the cash flow statement. Once the cash flow statement is created, the next thing that you should note is that for the future projections that you have made, so for example FY 10, 11, you flow them back into your balance sheet. Is that okay? So sort of your cash number is your balancing number for a balance sheet. So as you can see, the cash and the cash equivalents flow in from your cash flow statement to the balance sheet statement. So from the cash flow statement, I link that back to the balance sheet as my cash. So this is sort of a balancing number for a balance sheet. Now once the financial statements are complete, so sort of this completes your financial statements. Then what we essentially do is that we go about creating the ratio analysis. Okay, then we go about creating the ratio analysis. So based on the balance sheet, the cash flow statement, the profit and loss account, we create these ratio analysis to see how the company is doing. Now once this is done, so this gives you a basic understanding of how the company is doing. We do the valuation part. So if you go for the valuation, so the first part in your valuation is essentially your valuation through the free cash flow to the firm. So for that, what I do is that I calculate the free cash flow to the firm. I discount it based on my weighted average cost of capital to get to the share price. So valuation can be done in two ways. The first is the discounted cash flow method. For this, what you need is the free cash flow to the firm. Is that okay? The other way you can go about doing the valuation, that's very common in the industry, is the comparatives. Is that okay? Now within comparatives, you can have the transaction comparatives, okay, or you can have the trading comparatives. Is that okay? So what I go about doing is that I see what are the other companies that are there in the market, so that are listed or unlisted, what kind of transactions have happened in the past, and I go about calculating the valuation, right? Now once this is done, what I do is that to satisfy my manager and to show the right report to him, what I go about doing is creating a football field analysis for that. So essentially then I start doing the scenario analysis. Okay, now for scenario analysis, the first thing that I do is essentially I do a data tables to calculate the sensitivity of my variables, right? And the next thing that I do is that I create a chart to show sort of, so this is the data tables that I make to see what kind of sensitivity is there to the various parameters. And the other thing that I do is that I create a football field. In this football field, what essentially I would be doing is that I would be creating a chart which would say that the average price is somewhere here. My DCF gives me a price within this range. My comparatives by, let's say, the PE give me my valuation within this range. My comparatives by, let's say, EV by EBITDA gives me in this range, and the actual share price is let's say this. Is that okay? This is what my actual share price is. So this kind of an analysis is called a football field analysis. So these are the various steps that we would be following while creating a model. So this is just in a nutshell that I've told you. Just to summarize, the first part is to create an efficient layout. Then you input your historical numbers. You calculate your growth drivers. Then you create your assumptions. You project your future P&L and balance sheet. Whatever numbers cut across your P&L and balance sheet, you project them separately. Then you create the cash flow statement. You link that to the balance sheet. You calculate the ratios. You do the valuation, and you do a scenario analysis. So these are the steps that we would be following while creating a model. Obviously, we would be doing them step by step, and I think each step would take around 15 to 20 minutes. Obviously, some of these steps would take a little longer. So for example, calculating the growth drivers and creating our assumptions could take a little longer. So the overall time estimation for creating the complete model is around 20 hours. Is that okay? So I do hope that you have got some understanding about how we would go about creating this model. If you have any questions, feel free to write to me on paramdeep@edupristine.com. Okay. Alternatively, you could give me a call on 9892980608. My ISDN code is +91. Is that okay? I do hope that you found the session to be useful, and I hope to see you in the financial modeling class. Thank you.